right, I think we're going to start. Morning, everybody. Don't worry, I'm not going to say, I can't hear you. I hate that. So, thanks for coming, y'all. We do have handouts coming. They're being stapled. Having printer issues, but all right, we are going to have those. So, welcome. Glad you came bright and early to talk about the most fun thing in the world, right? Taxes. Here we go. And I'll just introduce myself here. My name is Dan Mullen, the CPA Mortgage guy. I've been a CPA for 8 years, and I like what I do quite a bit. I noticed, as I was doing CPA work, that my clients the difference between my clients who were struggling and those who were comfortable and even wealthy was almost always real estate. And whether that's a cause or effect, we're still figuring that out, right? But I loved real estate so much that I had to get involved. I started doing mortgages a couple years ago to be involved because it is a combination of real estate and math, right? Good stuff for me. So I love what I do, and I like to help realtors and real estate investors with their taxes because I can't think of a greater tool to help people choose how and when and even if they have to pay their taxes on certain transactions. Real estate gives you a lot of flexibility there. So it's a really nice tool. I hope you guys get a little bit better understanding of those both as an agent and as an investor, which is the purpose of this class. So, all right, let's get started. Okay, introductory video.
What's this? Looks expensive.
This is some new bedding.
David, didn't I just tell you to save your money?
Yeah, I am testing this out for the stores, so work is paying for it.
Work is paying for your bedding?
I was gonna leave, but now I don't want to. So.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the stores, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people. What? Why are we having this conversation?
So if I need booze to get through my day, I can just write that off?
That's a stretch.
But the skincare products you got this morning, those are a write-off.
What skincare products? You purchased skincare products?
Okay. I am the face of the company. If I have acne, what does that say about the legitimacy of the store?
That's not a write-off. That's not a write-off. This, not a write-off.
Oh, well, the bedding's non-refundable, so.
David, a write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Well, then I'll return some things. There's not enough space in here for the massage chair anyway.
I should get back to work, just in case any more of your packages arrive.
A lot of misunderstandings out there about tax code. Let's see, where did my mouse go? Here we go. It's kind of fun, right? Love that show. So before we dive in, you guys know the drill. Eliminate distractions, be here, all that kind of stuff. If you're online, this is not an online course, obviously. Keep questions general. We only have 2 hours here. I can't talk about your aunt who has a 33% interest in a charitable remainder trust. It can get really hairy really fast. So that kind of stuff I can do by appointment. That's fine. But try to keep questions general. That would be helpful to the rest of the group, okay? Whether it's for yourselves or for your investor clients, or even your primary residence clients. There's some stuff there too, right? It's really easy also to get political when we talk about taxes, right? There's a whole spectrum, right, where taxes are theft versus paying taxes is patriotic and everywhere in between. Don't bring that up. That's not really the point of this course too. We're not a political thing. I generally feel that we've never really gotten our money's worth when we pay taxes, no matter who's in charge. So But anyway, let's try to keep it apolitical if we could, please. Yep. Yeah, we're getting some more, I think, handouts. Is that what you're asking? Yeah, they're working on it, so thanks. Okay. So feedback is really important. I try to make this class better every time I teach it to help the community, the realtors and investors and people just a little more aware. And if I can get this point, this message across more effectively, that's going to be great for everybody, right? So course objectives, understand the value of legally taking advantage of the tax code, right? Not going to talk about illegal stuff here. Well, I will talk about it, but I won't suggest it. How and why to avoid an IRS audit. It's pretty nice, right? Because if you get audited, they will find something. They've got to justify their jobs. Not all of them do that, but a lot of them do. Entity selection too. Do I register as an LLC? Do I do an S Corp, an LLC, a PLLC, something like that? C Corp, partnership, whatever. Talk about that. Deductions and credits, the difference and which ones we want to take, which ones are applicable to you guys. What to keep track of, documents and such, and why you want to keep track of them. Make it easier for yourself and your tax preparer. Keep your costs low on your tax prep. Okay. Also, talk about the huge advantages of real estate investors. I hope you believe in your product enough to buy some yourself as an investor. Like I said, the best way to control how you pay taxes and when to pay taxes, and even how much or even when or if, is by real estate investing. A lot of tax code advantages for investing in real estate. Okay? Tax strategies with reverse mortgages. There are some really cool things you can do with a reverse mortgage that a lot of even loan officers don't know about that are really, really beneficial. And I'll talk about those in detail. Qualifying for a mortgage while self-employed. Why is this in a tax class? Well, because what do we use to underwrite somebody who's self-employed? Their tax returns, right? Their personal returns and their business returns. Okay? So I'm not going to go into detail on how our tax dollars are spent, just mostly to hit the point across that elected officials in Congress. Congress sets the tax rules, not the IRS. The IRS is just the enforcement arm of the Congress tax code, the code that the Congress writes, right? So, and the tax code is generally written to encourage certain behaviors, and sometimes to protect those in power, but mostly for encouraging certain behaviors like marriage, having children. There's credits and exemptions for that kind of stuff. Long-term investment, like a 401k, and real estate. There's a ton of tax benefits in real estate, right? So owning real estate, investing in real estate is something that the government wants you to do still. That's why it's in the tax code. So let's talk about the cost of not really knowing what you're doing with the tax code. So let's say we have an agent who makes $200,000. Pretty good year. Has $30,000 expenses, but another $20,000 that she has that she could have written off but failed to do so. If she just punches it in tax software, she might have a tax bill of something like $44,000. Oof, right? But hire a competent tax professional, pay them, a few $100, depending on how complex it is. Could get a little higher, but she does that, she saves, nearly $20,000. So those do-it-yourself types, if you know what you're doing, great. But if you don't and you want to just pay somebody to offload that work for you, it can save you a lot of money. That's a pretty good commission check right there. Maybe a couple even, right? So what about the person who tries to pull one over on the IRS, right? Sorry, the writing's kind of small there, but say that same person, $200,000, but they only report $50,000 to the IRS. Their broker reported the full $200,000, but they only reported $50,000. Okay, she gets audited, the lowest penalty she could receive. She has to pay her taxes, she has to pay those back taxes, a little bit more, right? Around $50,000, I don't know what it is exactly in this scenario. 20% penalty on top of those, which is another $10,000. And if you, quarterly interest on those unpaid taxes per quarter, so it's an extra $12,000, like it gets pretty heavy if you get penalized. So try to avoid an audit if you can. So you got to pay your taxes, but an extra $22,000 in penalties swinging the other way. Okay, penalty. Oh, and also, you have a higher likelihood of getting audited in future years and looking back other years if the IRS audits it any particular year. So try to avoid those. Pretty good idea. Okay, so what are some common audit triggers for realtors? Well, this one's almost automatic, and I call it more of an examination than an audit, depending on how egregious it is. But let's say your broker reports that $200,000 that you made to the IRS, and you only report $50,000. There's a big disparity there. The IRS says, oh, this person didn't report $150,000 in income. That's pretty much automatic. You'll get a letter in the mail at the very least saying, hey, you didn't report all this. Here's the amount you would owe if you had. Pay us, or we'll do an audit or whatever. Let's make it right? That's probably the easiest one. And why do the entities report that? Why does your broker report that to the IRS? Well, because they want to have a legitimate expense. If they don't report that to the IRS, then they get audited. They might have some expenses that they could have written off that they didn't. That's good. That's a good thing that brokers do. Businesses want to report their expenses, their payments to their workers and to their 1099 employees. So, okay. If there's significant inconsistencies, if you made, it's not uncommon if you have let's say you make $50,000 in 23 and $200,000 in 2024. That doesn't guarantee an audit, of course, especially with the income. If it's all reported, that's not going to guarantee an audit. But if you have, let's say you make $100,000 this year and you have $20,000 of expenses, and next year you have $100,000 in commission checks and you spend $80,000 on expenses, that might raise an eyebrow. It's not going to guarantee an audit, of course. It's pretty hard to do that, but it might raise an eyebrow. And if you can justify that, yes, I really did spend $80,000, and you get audited, that's okay. They'll see that, and if you documented it correctly, you're working with a good tax professional, you should be fine. Okay? Oh, and also the IRS gets tax returns from every realtor in the country, well, hopefully, most of them at least. So they have a good idea of what revenue and expense ratios are there for most realtors, and they kind of use that as guidelines historically. Yeah? Do I know what the ratios are? They usually keep that pretty close to the vest. They don't like to do that so people can intentionally play them, right? If you're just honest with your expenses and your revenues, you have no problem. Right? Okay. Using lots of round numbers. Yes, I drove exactly 20,000 miles that year, business miles that year. I had exactly $30,000 even in expenses. It's like, this person is guessing, they didn't actually do the work. Maybe we need to do an audit, okay? Deducting personal expenses, this won't necessarily trigger an audit, but it will, if you get audited and they can catch you, they can penalize you for that kind of stuff. So if you put your groceries, your personal groceries for your family and put it in your business expenses, that's not going to trigger an audit because it's not how much did you spend on groceries this year. That's not a question on a tax return, right? But if they do audit and they find that you did something like that, or you can't justify what you spent, yeah, you'll get penalized for that. Okay. Other audit triggers for people who aren't necessarily realtors. Cryptocurrency is a big one. Net operating losses. If you have net operating losses year after year after year, that looks a little more like a hobby to the IRS than a profession. So it might be like, oh, you can't write these things off because this isn't a profession. Not necessarily, right? It's justifiable if you have a downturn in a market, for example, right? Heavy use of tax credits. The ERC, the IRS is dropping a big hammer. If you don't know what ERC is, it means employee retention credit. A lot of companies out there that are fly-by-night and going to get hammered by the IRS, they don't sign the returns. They say, hey, you can get all this money from the pandemic that the government promised, and then they do, and then they'll come back. They hired a lot of IRS agents just to address that. So if you had one of those, or for your business or whatever, you should let somebody know who's a competent tax professional because they can help you avoid some of those penalties. Okay, research and development, that's another one. But that doesn't really apply here in this room very much, I don't think. Several years of net losses in a row, it's kind of in the same lines as these net operating losses, right? And lots of transactions with audited parties. You don't know that necessarily if you're doing a lot of work for your broker and your broker gets audited and they don't necessarily advertise that right. But that might raise your audit risk a little bit. Okay, so let's talk about what happens during an IRS audit. First of all, most of the time it's just done through the mail. Almost 80% of the time, you'll just get a letter. A lot of them are called exams or examinations and not audits necessarily, which is you'll get a letter in the mail. It's called a CP 2000 or a CP 2500, which will basically say, hey, here we found a discrepancy. Here's what it is. You owe us this amount. Write us a check, or you can appeal it, and we go on with our lives. Okay. It's never through email, it's never through text message. Phone calls are pretty dang rare. And usually it's almost always preceded by a letter in the mail. They give you plenty of time. So a phone call, I mean, this happened to my wife a few years ago, where somebody called claiming to be the IRS. Hey, the police are on their way unless you wire us $5,000 immediately. She was freaking out. She didn't know. I'm like, honey, sit down. We don't need to pay these people $5,000 in iTunes gift cards. That's not how the IRS works, right? So phone calls are usually uncommon. They're never immediately threatening. They just say, hey, you've been selected for an audit. Here we go. You probably got a letter in the mail about it. You know. Oh, yeah, never give credit card, debit card information over the phone, obviously. Someone claiming to be the IRS, it's a very popular scam. They don't know how to text. They're still in the dark ages, so they don't text message. They still use faxes, for heaven's sakes. So they're not going to text you. So after that, they'll usually do a phone call, and then they'll do an in-person interview. It could be either at your office or theirs, and they'll ask you to bring certain things. You know, you probably want representation there with you, either a tax attorney or just your CPA. Okay, they can do that. Again, almost always preceded by snail mail. Okay, like I said, you can file it through the courts, you can appeal it, especially if your CPA is like, no, they're wrong, and people do win appeals. It's not given that the IRS will win a case against you. It happens all the time, whether they don't. So anyway, so let's talk about penalties here. Negligence versus fraud, they're almost always going to assume that when you have a mistake on your tax return, that it's going to be negligence. You don't know what you're doing, whatever, unless it's deliberately, like you forged a check, that's going to be considered fraud. But negligence is just, 20%. There's no criminal penalties there, just the 20% penalty there, plus interest over time. Okay, fraud is intentional. Like I said, forge a document, sign a bad check or something like that. Yeah, they're first going to assume negligence. That's how they got Al Capone, right? Through taxes. He was doing all kinds of stuff, kidnapping, drug running, murders, you name it, he did it. Because they wrote the tax code in a way to catch him, that's how they did it. So, and even one of the most infamous villains of cartoons, you can't see that, says, I'm crazy enough to take on Batman, but the IRS, no thanks. Yeah, anyway, I'm not trying to scare you too much, really. Most of the time, if you do what you follow the rules, generally speaking, even if you go through an audit, you'll be fine. Okay? So how do you choose a tax pro? I'm not going to go through every single one of these, but it's important to know, how do you keep my data secure? Do you have E&O insurance? How do you charge? Is it by the hour or is it by form? What are your typical response times? What's your specialty? Do you specialize in real estate? How many real estate clients do you have? Investors or agents, whatever. This one's a little trickier. How often do you get audited? A lot of the good ones will answer honestly. It's like, yeah, my clients do get audited, and sometimes it happens. It's just inevitable. If you have a really complex tax return and they're taking a lot of different credits, we prepare them well and defend them in an audit. That happens, it's okay. But if they have a lot of clients who are getting audited and having penalties, that can increase your risk of an audit too, because they're going to assume maybe all of their clients are doing weird things like that. So some pretty obvious red flags here are going to be promising higher refunds without examining documents. Oh yeah, I'll get you a better refund. They don't know that without looking at your documents, right? Not signing a return is a huge, huge red flag. You want to get that return signed, right? A lot of R&D or the ERC companies aren't doing that. Or if you have a relative who's going to do it in TurboTax for you, but they don't sign it, it's kind of a red flag, right? Refund-based fees, that's illegal. You're not. If I get you a refund of $2,000, I want $200 extra. If I get you a refund of $5,000, I want $500 extra. That's illegal. Okay. Any questions on that? By the way, questions are welcome anytime. No worries, right? It's an open classroom. Okay, so let's talk about who's responsible for the tax return. Number one, I'm not an auditor. I'm not going to go through your bank statements line by line. Is this really a marketing expense? Is this really, how many miles? I'm not going to look at your odometer, right? We're not auditors. So we're going to trust that usually at the end of the year, the beginning of the year, we send you a form. It's called the business organizer or a personal organizer, they call that, which will ask you, okay, how much did you spend on marketing? How many business miles did you have? And we're going to trust pretty much everything you put in there, unless something looks really weird, then we'll ask you about it. But we're not going to go through your bank statements and look line by line to check. We don't have time for that. We're doing hundreds of returns in the springtime, right? So the most important signature on that tax return and the most liable one is yours, right? So keep that in mind. Yeah, we're not going to do that. So yeah, there is some liability if there's evidence that we directly misguided you on a tax rule. But for the most part, it's going to be, penalties are going to fall on you, okay? So let's talk about tax entity selections. Should I do an S Corp? Should I do an LLC? Should I remain as a sole proprietor? So an important distinction is it's not LLC or S Corp. It's not LLC or sole proprietorship. An LLC is a entity that is set up by states, right? It's recognized by states. The IRS doesn't recognize LLCs technically. So what you do is you set up your LLC and then you have an election to choose how to be taxed. Okay, you choose to be taxed as an S Corp. If you do nothing and let the default, you essentially choose to be taxed as a sole proprietor, which is a Schedule C on your 1040 form if you guys care. Partnership, if you have multiple members in an LLC, the default is a partnership. The way you are taxed is a partnership. C Corp, that's a special thing. I've never seen it where it makes sense for an agent to have a C Corp really. Sometimes with certain real estate investors, they get really complicated. That might be beneficial, especially if they're seeking investors. But for the most part, C Corp, I'm not really going to talk about that. Okay? PLLC just stands for professional LLC. The IRS has indicated they want people to start moving towards that, especially real estate advisors or real estate agents like you guys, because the financial impact of your clients' lives is pretty big, right? Sometimes it's the biggest financial impact in their entire lives. So the only difference there is they want you to register everybody who's involved in that, which is really simple. Like, here's my name. There it is, for the most part. Okay. So like I said, an LLC or a PLLC contains, in a way, right, your S Corp or your sole prop or your partnership or your C Corp. Okay.
Question on
Yeah.
the partnership.
Sure.
Can you have a partnership if there's only one person involved in the company, or you're saying partnership meaning two or more people?
The question is, can you have a partnership if there's only one person? The answer is no. Pretty straight up. You can have an S Corp with multiple partners, and obviously a partnership has to have multiple partners. And there's pros and cons to each one.
So in an investment property that you own, you should have a PLC.
We'll talk about that. Invested properties that you own. Well, no, I can answer that now, I guess. You like to see them in an LLC, and that doesn't, what an LLC does, it stands for Limited Liability Corporation. And essentially what it's supposed to do is protect your personal assets from being when the business is sued. Most lawyers can get around that. Your best protection, especially in investing in real estate and as an agent, is to have robust insurance. So if you're an investor, you want to have good GL insurance, general liability insurance. If you're an agent, E&O insurance will protect you far more than just having an LLC. Okay? Good question.
Can you tell me again you said GL insurance for an investor, or what?
Yeah, general liability, GL, yep, for investors is what you want. I mean, it's easy to set one of these up. Most accounting firms can do that. A lot of attorneys can do that. But general liability insurance is going to protect you more. Yeah?
So if you're going as a sole proprietor, do you have to have an LLC set up, or?
Nope, you don't have to have an LLC set up to be a sole proprietor. You can, I recommend it because it's cheap. And it does provide some protection, but you don't have to. Good question. Okay, let's talk about each of these. So an LLC is an entity. Again, it's not recognized by the IRS. It is recognized by each state, and they have their own rules. Most of them are pretty dang similar to each other, state to state. But again, it's designed to protect personal assets from business liability. So if your business gets sued, it's supposed to separate that. Like I said, a lot of lawyers can get around that, but.
Is there a reason it's not, I don't know if you know this, is there a reason it's not covered by federal IRS, but the others are?
Because they're pass-through entities. The question was, is there a reason they're not recognized by the IRS? They're pass-through entities, so there's no real reason for the IRS to recognize those. And I'll talk about that in a minute, okay? Good question. Yeah, most states, including Utah, allow for single-member LLCs. That's just fine. Okay? Some types of businesses aren't allowed, like banks and insurance companies. You guys don't have to worry about that. Single member, so yeah, default tax structure. If you are a single member LLC, you're going to be a sole proprietorship unless you make a special election, which I'll talk about. Multiple members, the default tax structure is a partnership. Okay? And you can elect to be taxed as a different classification. So let's talk about sole proprietor. My dad jokes, sorry. So sole proprietorship, that's okay-ish for net profits for you guys for up to about 30 to 40,000. Once you start approaching 40,000, and I'll show you on a sheet that I built, it starts to make sense to start to form an S corp or to elect to be taxed as an S corp. Okay. So the overall difference is, you want to take into account both the tax differences and the administration costs of forming an S corp or not. Okay. And I'll talk about that more in detail in just a second. So the biggest difference too between different entities, especially in S corp and pretty much everything else, is self-employment taxes. You have a little bit more leeway on self-employment taxes than you do with a sole proprietor than an S corp. So, okay, so yeah, great tip, have a business bank account. It's really hard to get everything in line when all your expenses your personal and your business expenses come from one credit card or one debit card. So have a business bank account. So how do self-employment taxes work? So essentially for W-2 wage earners, like people who just have a regular job getting paid W-2, they pay half of the self-employment taxes. Your employer has to pay the other half. If you are both the employee and the employer, you pay both. So that is a total of 15.3%. Like I said, the employers pay half of that, 7.65 typically, and then you pay the other half as a W-2 employee if you were one of those. Okay, but like I said, self-employed people like yourselves pay the full 15.3 on top of their income taxes. Okay, good stuff, right? But only income up to $160,200 is subject to that Social Security taxes. Medicare taxes go as long as you're making income, you're going to pay Medicare taxes on those. Okay, this limit increases. I think it's closer. It's $168,000 in 2024, I think. But you guys get the idea. So let's talk about S corp. Letter S. So like I said, an S corp and a sole proprietorship and partnerships are called pass-through entities, according to the IRS. So that means any profits or losses that the S corp makes are just filtered all the way through to the owners, whether that's you as a single member or your partnership, all the partners. And that depends on what percentage. If you're in a partnership, that depends on how much percentage of that company you own. It's also true for an S corp. So employment taxes are still due, but you have a lot less. You have a little bit more choice because you can pay yourself a salary, and the salary is the only thing that's going to incur self-employment taxes. Okay. So between 20 and 50%, 20 is really aggressive, but 20 to 50% of your net profit. So if you make $200,000, let's say you take 50% as wages, you're only taxed self-employment taxes on $100,000. Save you a lot of money. So, said you can start to think about an S corp when you reach about $40,000, and I'm going to show you the math on that too. This is one of the, I think it's the second to last sheet on your handout. You can kind of see the example I have there. I think I have different numbers in the handout, but it just generates, it just kind of proves the point there. Should I file an S corp? And I have a QR code too if you want to play around with that yourself. I think it's on the page. But in this example, I've got somebody who's making $40,000 and has $10,000 of expenses. And then here's the difference. Again, the reason you don't start from, oh, I make $10,000, should I start an S corp? Probably not. Because the cost to file your returns is more expensive. Like for us to file an S corp, to get the entity started, it's like $850. But then to file that extra form, there's another charge on that because they're a little more complicated to do. And also you have to do payroll and that kind of stuff. It sounds like a little bit of a headache, but you can pay people to do this and they don't charge very much. So.
Just real quick, you've got 60,000 on that.
Yeah, okay.
Just so you know.
Okay. I'm going to go through 40,000 too. So if we have $40,000 in net commissions and $10,000 in expenses, and you pay yourself 50%, your salary is 50% of your net profits, which is very reasonable for a realtor. Don't worry about all the math, worry about the result down here. S-Corp savings cost, that's where you're flirting with the idea of having an S-Corp. And I'd rather do that than not, because one more benefit of having an S-Corp, it lowers your chances of an audit. Because if they see, oh, this person knows enough to file an S-Corp, they know what they're doing, it's going to lower your chances of an audit. So, and you net an extra $145. That's a few lunches, right? You can take your tax professional out too if you want to. But if the savings really, really ramp up. So let's say this person makes $100,000 and has, I don't know, $20,000 in expenses. They're saving nearly $4,000 by having an S-Corp, right? Pretty big savings. It's a good idea. Plus your lower chance of having an audit. It's gonna be worth it. Any questions on that?
Just to make sure that, so this is just an entity for taxing, but as far as liability, your insurance is gonna be better, because it's the same as just an LLC when it comes to protection, personal protection.
I'm assuming that if you have an LLC, you are filing as an S-Corp. See, you have an LLC and that has its default, but you elect to file as an S-Corp, that's where you see those. And like I said, the protection on the LLC, it's there a little bit, but more robust if you have good insurance, like E&O insurance as an agent and general liability insurance as an investor. Okay, does that answer your question?
Yeah. Yep.
Thanks. Any other questions? Yeah.
So in this example, for the salary line, are you just leaving that other $40,000 in the bank and you can't spend that, or how do you treat the other?
No, you can take it as a distribution. You can take all of that money if you want in that year. You can leave it in there to fund your business or whatever, but most people just take it out as a distribution. That is not subject to self-employment taxes. It is subject, your profits are all subject, no matter what entity you have, your profits are all subject to income tax, right? That's different. But self-employment taxes are where the savings come in for S-Corps. Okay? Good question.
Can I have you explain your distribution, right? You're saying you can take a distribution, meaning what, and not get taxed? You can take it out
and not get self-employment taxes on it.
because you're not paying yourself.
Yeah, you're not paying yourself via salary. Yeah. You're making more than that, and you can take a distribution because that's the cost of risk, is kind of how the IRS sees that. Just take it. Again, your income taxes, but not self-employment taxes. Okay? Good question. Any others?
How often can you take distributions from an S-Corp?
As often as you want, but administration costs might. It's just a bank account, it doesn't matter. You can take one every day. So, I don't really care. If it's set up in like a, high savings yield account or something like that, or HSY, then they might have some kind of fee for, I don't know, but it's not significant and there's no limit. Yeah, question?
So when you pay your own salary, do you also need to pay the FICA?
Do I need to pay the what?
The FICA.
FICA? That is, FICA is the same thing as self-employment taxes or employment taxes.
So when you take out for, like, I pay my own the salary, do I still need to pay the FICA?
So so the question is, if I pay myself a salary, do I pay myself, or do I pay FICA taxes on it? FICA is essentially the same thing as employment taxes, so yeah, you do. You have to pay FICA taxes on any salary you take out. Same thing here. Good question, thanks. Any others? Okay, let's go back to this. Yeah, like I said, lower chance of getting audited when you have an S-Corp, because it looks like you know what you're doing, or at least your tax professional does. Okay? All right, so let's talk about partnerships. I'm not going to spend a lot of time here because generally not advantageous to be a real estate agent in a partnership, because you're subject to the active partner, the one who's doing work, and the owner of the company is taxed. Their taxes are self-employed taxes. You're subject to self-employed taxes. You can pull it off too, especially if you have someone you trust, like a spouse, for example, and they are a passive partner and they contribute a lot of money and do most of that. You can avoid a lot of those self-employment taxes, but it's cleaner with an S-Corp, and you can do multiple member S-Corps anyway. But again, like taxes are passed through to the owners, just like an S-Corp. It's not really recognized by the IRS as far as the entity itself isn't taxed. The only time that's true is when you have a corporation. is the entity itself is taxed. The profits that the entity makes is taxed, and the money coming to you is taxed as income tax. That's why most people avoid C Corps when they're real estate agents and investors. Small businesses, right? Okay, contribution and distribution rules are a little bit different. Partnership tax returns are a lot more complicated. They usually cost a little bit more too. And if you make a contribution of real estate or cash or services or whatever, it gets kind of hairy pretty fast and can be kind of confusing to someone who isn't in that sphere all the time. Moral of the story, S Corps are great for realtors. So what about S Corp versus partnership? Usually, like I said, S Corps are usually preferred for agents because you can avoid those self-employment taxes. A passive partner in a partnership can avoid those self-employment taxes. By the way, it's investing in real estate. You don't need to have a partnership or an S Corp for that. Partnership's okay, but it's really tricky to hold real estate inside of an S Corp because there's rules for when you do a quit claim or when you transfer it from one member to another, it might trigger capital gains. So if you're gonna hold real estate, you can have it just in a sole proprietorship because that doesn't have employment taxes anyway, self-employment taxes. So, and those are just usually found on what's called a Schedule E on your tax return. But you don't need to have an S Corp for each one. I would generally put up to 4 properties in each LLC. You don't have to have one for each one. Some people do, that's fine. But yeah, holding real estate in an S Corp, I generally don't advise that if you're doing it yourself. Okay, it can be navigated with a good pro, but there's a lot of rules in there that we won't get into today. Okay?
So you said for multiple properties up to 4, you say it's all right to put them in a single LLC?
Yeah, again, that's a personal preference too. If you feel like you're going to get more protection with having one in each one, that can get pretty expensive to have one for each one, but you can do it if you want to. I mean, you want to limit that liability because if somebody sues the LLC, they can go after anything in that LLC. So a lot of investors do their own LLC for each property, and that's okay. They have to have tax returns for each one too. So.
But if you have the general liability, like an umbrella policy, covering the entire whatever worth of all of the assets.
So yeah, you can have an
It's kind of redundant. Or?
Well, no, you want to have a robust GL policy. Like I said, that's your best protection. And sometimes it depends on the carrier, the insurance carrier, as far as I understand. They might want to insure each LLC on its own or the parent company, if that's a partnership or whatever LLC. But just ask your insurance carrier on that. It's a better question for them. So,
Question.
yeah.
So to set up, as far as for investments, if you have a partner, say I have one son and we're in one property, another son is another property, that partnership is the best way to probably do that, right? Individual partnership?
Yeah, well, if you're splitting them up, it gets kind of hairy. If you have percentage of ownership in different properties, you can outline that in your operating agreement if you want to, your articles of organization. It's a little cleaner if you're going to have different owners and ownership percentages to have their own LLC stating such. But yeah, that's a good question. We're getting a little bit into the weeds there, so let's take it general. Yeah, so be careful when you're trying to own real estate properties, investment properties in an S Corp, okay? Real estate professional status. This is awesome for you guys and for real estate investors. Anybody heard of that before? Real estate reps, they call it that, yeah? So essentially, like these fine people are real estate professionals, in a way. Selling sunset, right? Okay, so real estate professional is classified as someone who both spent more than half of your work in doing active real estate work. And that can be buying and selling properties, helping brokering properties out. So what your everyday job can be considered real estate hours toward real estate professional status, okay? Also in there is property management, and there's also, you have to spend at least 750 hours of those hours doing real estate, buying, selling, helping clients that, or doing your property management on your investment properties to qualify for real estate professional status. And more than any other job.
Time?
Sorry?
750 hours in a year's time,
Yeah, every year, thank you.
every tax year.
Yep, every tax year, 750 hours and more than any other job. So if you have an engineer working 2,000 hours a year, and they want to qualify for real estate professional status, they have to work 2,001 hours doing real estate stuff. If the IRS sees that, they're going to be like, nah, you're not working 4,000 hours a year. 16-hour days, come on. They're probably going to get audited, okay? But yeah, that's your minimum, 750 and more than any other job, okay? So unfortunately, title, mortgage professionals, inspection, appraisal, that doesn't count as real estate activities to count towards these 750 hours, unfortunately. They have to be doing things like property management. So, material participation in your properties. That means you're actually there either swinging a hammer, doing property management, finding tenants, making repairs, doing upgrades. Well, I can talk about why it's actually not in the slide here, why you want to be real estate professional status. Normally, when you invest in real estate as a passive investor, that's considered a passive investment. Say you're an engineer who works 2,000 hours a year and maybe spends 100 hours a year investing in real estate. And on paper, they have a loss of $50,000. You can't take that full $50,000 on a loss against your active income unless you have real estate professional status. You are limited to $25,000, and that starts to taper off after your adjusted income is $100,000, and it wanes entirely at $150,000. So if you have that engineer who's working 2,000 hours a year as an engineer, and he has a $50,000 loss, and he makes $150,000 in his salary, W-2, he doesn't get to take any of that paper loss against his $150,000 salary. This is unlimited if you are a real estate professional. So you have, maybe you do a cost seg study on an investment property, which lowers your taxable income by, $120,000. You can take that full $120,000 and net it out against your real estate commission income. Can't do that as a regular W-2 employee. So big benefits to that if you are a real estate investor, okay?
Where is that reported to? I mean, the IRS calls you, or reps, or what? I mean,
well, you put it on a form, like, how many hours did you work? And your tax preparer will ask you that, if you're seeking that. So most of the stuff you don't have to worry. I mean, we'll ask you on that, say, hey, I invest in real estate properties. That'll come up in the interview, right? Okay, now let's talk about reps, real estate professional status. Do you qualify? How many hours did you work? We'll get to the bottom of that. Okay? Any questions on real estate professional status? All right, let's keep it rolling. So what's a deduction versus what is a credit? Okay, a deduction, which is a write-off, which is a tax write-off, right? It basically reduces your taxable income. It doesn't reduce your taxes directly on a one-to-one basis. Reduce your taxable income. So if your marginal rate is 24%, for example, you have an eligible business expense of $1,000 and your marginal rate is 22, then it lowers your tax bill by $220, okay? Whereas a credit, kind of hard to see there, but anyway, it will directly reduce your tax liability dollar for dollar on a one-to-one ratio. So say you have a child tax credit of $1,000, for example, it reduces your taxes directly by that $1,000, okay? It's the difference between the two. Clear as mud? All right. So I always find it funny when people say, oh, they're donating to charity just to get a tax write-off. That doesn't really make monetary sense because they still have to spend the money to get the write-off. So if they spend, let's say they give $100,000 to charity, that doesn't reduce their taxable, it reduces their taxable income, but they still have to spend the $100,000. So it's a net wash. It's buying them social capital maybe, right? Hey, look what we're doing in the community, but it doesn't really make them any more money or save them more money than they would have spent otherwise by writing that off, right? Okay, so deductions, business expenses. That's the obvious one. We'll figure out what those are soon, right? Costs incurred in the ordinary course of business, used exclusively for business use, right? That's what you can write off. So things, you guys know these, marketing, signs, advertisements, license dues, professional memberships, that kind of stuff. Those are all business expenses, right? Bookkeeping, accounting, everything you need to run your business, expenses to run your business, you can deduct, okay? You can write off. Seminars, this CE class if you had to pay for it. Cell phone bill, this one's a little bit of a gray area, but it's hard to do business without a cell phone in 2023 and an internet connection, by the way. So you can write off, some will say write the whole thing off, some will say write only your portion off, or your business portion off. That's so hard to quantify. So a lot of people will get it through just writing the whole thing off. Not their family's plan, but just their portion of it. So if you have 4 members of your family in one bill for $100, write off 25 bucks of that. Okay. Home office deduction, just like, I should remember her name, from Devil Wears Prada. Well, I know, yeah, her actress name. I forgot her name in the movie. She's a great actress. So it's based on the square footage of your home. There's 2 ways to calculate it. Don't worry about it yourselves. We'll ask you those questions and we'll pick the better one. Your CPA will. The office is supposed to only be used for business. If for some reason you get audited and they happen to go in your home and they see that your home office looks like a theater room, they might, be like, nope, sorry. They're not going to know how many hours of business you spent in there versus taking a nap on your recliner. I don't know. Anyway, so home office deduction can be pretty useful. When you sell your home, this is kind of depreciation in a way. So when you sell your home, however much you took out of that will be added to your capital gains if you have those. I'll talk about capital gains in a minute. So going super aggressive on that might bite you on the back end when you sell, but usually useful because there's such a big exemption when you sell your personal home. Yeah?
So we rent our home for corporate meetings once a month.
Great.
Does that mess with when we sell our home? Do we have to, because if we rented an event space, it would be.
You're referring to something called the Augusta rule, renting out your home for business use. I'll talk about that. That's a great rule.
How far back did they go on that, the recapture?
As far as you've owned a home.
Really?
Yeah.
Question on the home office. I've always heard, maybe this is a misnomer, but when you claim a home office, you are more likely to be flagged for an audit.
It could. It's not significant. The IRS right now is focused on different things. If you claim a home office and it's like 80% of the space of your home, yeah, you might get flagged for audits because most home offices are, between 5 and 10% of a given home. So, yeah, I mean, there's ways to do that if it looks weird, but it's not a given. Yeah.
I remember that if we only claim like 1,500 something, we don't need to put it back when we sell the house, right?
Well, you can. It just depends on how you calculate it mostly, but for the most part, they're both going to recapture that when you sell the home. But it's probably not going to affect it if your home didn't appreciate more than $250,000 or $500,000, which I'll talk about soon. It's called the Section 121 exemption. Okay. Any other questions on home office? Those were good. Okay. Vehicle. This is a hot topic, right? So there's a couple ways you can do that. Either take mileage, which is 65.5 cents per mile right now. It's pretty good. In most cases, you want to take mileage for a couple reasons. Number one is it'll net you less in taxes, but number two, it's actually better when you're trying to qualify for a mortgage because that doesn't count as a cash expense on a mortgage application. So any expense you have on your mileage, it's added back in to boost your income for mortgage qualification. May not be much, but it could help. So it's also really easy to track if you do it with apps like MileIQ. I've got no affiliation, of course. MileIQ, QuickBooks on Self-Employed has their app. I think Everlance has a free one. There's a few out there that make it really easy. So at the end of the day, if you let it track you while you drive, at the end of the day, it'll pop up, hey, let's allocate your miles. You went from here to this place to, I don't know, to the Utah Central Board. Is that business miles? Yes. Oh, you went to go have lunch with a friend or your best friend who you didn't talk about real estate, whatever, personal. It makes it really easy for you to keep track of those. So you have backup if you do get audited, like, yeah, here's the records, here they are. Yeah, they're pretty great. And they're usually pretty cheap. Okay. If you want to do expenses, you usually do a percentage, meaning a percentage of your business miles versus, or not miles, percentage of business. Let's say you do 50% of your driving for business purposes, to go to UCAR, to go show clients homes, to, do your real estate stuff. And the other 50% you use for personal use. Then you take all your costs there, which is your gas, your repairs, car washes, parking and tolls, that kind of stuff too. By the way, parking and tolls you can actually take if you're taking mileage as well. So if you have to park and there's a cost for that, save that receipt. Okay. But yeah, all your expenses, then you add all those up and say, okay, I used my car 60% of the time or whatever it was, and then we'll take that and allocate those expenses. You get to write off 60% of those expenses. Okay. So generally, especially with the mileage rate, what it is, 65.5% or 65.5 cents, generally going to be higher. One thing to note, if you go to mileage, you can't go back to actual expenses. So you have to pick one or the other, essentially, and stay with it, as long as you're driving that car for business purposes. Okay? Yeah, there's also...
What's your take on leasing versus mileage?
It depends on what's better for you. That's more of a personal decision. You're leasing, you can write off your lease payments up to the amount you use for business. So if you lease a car for $300 a month and half of your miles are business miles, then we'll write off $150 of those. If you own the car, you do something else. You do a depreciation, usually over 5 years, unless the car is over 6,000 pounds, like this one. Oh, one of those wheels is probably 6,000 pounds. Goodness. But the 6,000 pound rule, people ask about that one a lot, is you can depreciate the whole thing in the first year that you buy it. So, December 25th rolls around like, hey, I made some good money. I want a good deduction and a cool car. I'm going to buy a $100,000 Suburban. You can write that whole thing off first year. It's called the Section 179 depreciation rule. Problem is, there were two problems with that. First is, if you do that and you only made $50,000 that year, you're wasting a lot of that deduction. It brings your taxable income to zero, but it's not helping you as much as it could if you made more. Now, the numbers change, right? And you can buy an old 6,000 pound vehicle, and if you don't buy it from a dealership, you can look them up online. They're pretty easy. How much does this car weigh, make, model, year? They'll tell you. But another thing too is if you do that and sell that car the next year, then you will have $80,000 of depreciation that they have to get back. So you have a capital gain in there. So if you buy it and write the whole thing off that first year, it can be awesome if you keep that car for at least 5 years. Okay? Or you can handle getting some of that depreciation back, because if you sell it within those 5 years, they want it back, because that's a capital gain. They gave you this bonus to use it, not to abuse it, right? Okay? And the dealer, if you're shopping for a new car, the dealer will know this too. So, okay. Any question on vehicles?
I heard they're going to change that.
I'm not going to say one way or the other because they haven't yet. They might be talking about it. They're changing bonus depreciation slowly. It's a different topic. But
Only 80%?
that's bonus depreciation. That's different.
Okay.
Yeah. Any other questions on vehicle?
Now it's good.
Yeah. Go for it. If you make a decent amount of money, buy a big, heavy car. There's environmental impact to that too, and gas prices, which might hurt more than you save on taxes, but it's a personal choice. Yeah.
If you sell that car to a family or someone like attached to you, like for $1, can they come back at you for that?
Yep. Yeah. If you get audited and they see you sold it to someone for $1, they're gonna want fair market value tax implications of that. So trying to pull a fast one on the IRS rarely works.
So if you sold it for less, you should claim fair market value.
Yeah, you'll have, and don't really talk to your tax professional when it gets to that point. So we'll talk you through when and if and what the tax implications are of that. It gets a little bit in the weeds, but it's not a bad question.
What if you decide to sell it in 2 years and buy another one? Do you do that, or do you recommend the...
Sure, but they'll claw back the whatever. So again, they're normally depreciated over 5 years, vehicles are. And so if a $100,000 car, you'll have $20,000 for 5 years. And so if you sell it after 1 year, you'll have $80,000 left that's sitting there that you'll have as a gain or whatever. So they'll want that back. Okay? And electric vehicles, I'll talk about that as a credit in a minute. But so travel expenses. Whenever I think about traveling, I don't know, I think about this guy. So doesn't play for Houston anymore. But anyway, conferences, trainings, client meetings, stuff like that. If you have to, I think there's not really an official rule, but if you have to stay somewhere else overnight and you have to, it's like a 100-mile radius-ish or something, then they're going to consider you being on a travel, and you can write off travel-related expenses. So if you going to Salt Lake City to meet a client, that's not really traveling, right? Because you can go home and sleep in your bed. It's a 20-minute drive. So conferences, trainings, client meetings, that kind of stuff, right? 4 hours a day rule. So meaning if you go to, I don't know, California and you have a real estate investing conference and you're spending at least 4 hours a day doing that, doing business like attending trainings, networking lunches, that kind of stuff, having a board meeting somewhere else, you could do that. Spend at least 4 hours a day doing that, not looking at houses, not on the phone with your clients back home, unless they're wanting to buy properties that you're looking at when you travel. Doesn't make a lot of economic sense, but you could. 4 hours a day is all it takes to count business expenses. What does that mean to have a travel day? That means airline tickets, half of your meals, all of your lodging can be written off. Okay? So not entertainment anymore. Tax Cuts and Jobs Act of 2018 kind of smacked that down. So if you go to a golf outing or a concert or a pro sports game, you can't write that off as entertainment expense, as a marketing expense, as a client appreciation thing. Client appreciation events are a little bit different. If you're hosting something at your office or at a park or something, you pay for that, and it's not like a concert or something. If it's a client appreciation, you go ahead and write that kind of stuff off. But actually just going out with like one client or something like that to see a concert, yeah, they're a prospect, I swear. They don't really allow that. So that one gets a little gray sometimes, especially when you're doing client appreciation events. Question?
So let's say you're at a conference and a big group of you goes, like a bunch of agents around the country, and like people that send referrals and whatever. A bunch of you go do something social after meetings. Can you write that off?
You can write off the meal portion of that.
The meal?
Yeah.
So like Mickey's Not So Scary Halloween Party.
Mickey's Not So Scary Halloween Party. No, that would be considered entertainment. That sounds like a good time. But it's entertainment. Write off the meal expense, or at least report the meal expense. We'll do the 50% calculation on that. Because other realtors are referral partners, right? Sure. Yeah. Sorry.
Just on the 4-hour rule, travel days are excluded from that. So if you need to travel to wherever you're going, even though you don't have a meeting that day, you can get a hotel and write that day off.
Sure, yeah, travel days, you can attend that conference without traveling, right? If it's in a different state especially. So yeah, that's a free day pretty much. You're gonna spend 4 hours in an airport or on the plane or both. That's not hard to justify. So yeah, travel days, count those. So what about if you take a vacation day before or after? You wanna see some sights. Let's say the conference is 4 days and it's in Hawaii, you wanna spend an extra 3 days, going to the beach and stuff. It's actually prorated. So if you have 4 days of trainings and 3 days of vacation, take all these expenses, airline tickets, meals, lodging, and you have it to multiply it by 4/7. See what I mean? So it's prorated. So the days you're on business, you can write off those expenses, that ratio of that, okay? So find another way to make it a business day, or take sightseeing stuff separately or whatever, if you're thinking about taxes and taxes alone, right? There's a lot of other reasons to do things like that. So, okay, any questions?
If you're in an LLC, you're required to have a certain amount of board meetings or whatever, is that correct?
Yeah, well, yeah, you want to have proof that you are an actual company, and one of those is having board meetings. Even single members, you can like to see those too. And meals, by the way, these can be personal meals. If you're out traveling outside of that radius where you have to sleep somewhere else, your own personal meals can count as a business expense. However, if you are in town, there's a little bit different rules for that. So these fun people are having dinner. I love this movie. They're definitely having a business meal, right? So the rule of thumb is if you're not traveling, if you're within your hometown radius-ish, eat with somebody. And write a note on the receipt, keep your receipt, write a note on the receipt, who you met with and why you met. Just a quick jot, like 2 sentences or whatever. Hey, met with Bob Bailey, talked about investment properties. Great, write it off. You don't have to pay for that person. You can if you want to and write off that, that bill, and you'll have a tax deduction of 50%, but eat with somebody, okay? And talk about business, which you always do because that's what we do, right? We're in real estate. Can't help it. And it's not supposed to be considered lavish or extravagant. I've yet to find a restaurant in Utah that would qualify as lavish or extravagant. Even Ruth's Chris, somewhere like this might have ice sculptures and gold bullion in the dessert, right? Not a lot of those in Utah, so, okay? Meals to network, there's a lot of reasons you could have meals. Meeting with prospects, clients, referral partners, vendors, whatever. It's all gonna be deductible, okay?
So I heard that if you took a meal back to your office, that's 100%. Is that right?
You buy it well, it depends on, if everybody at the office is allowed to have some, then yeah, you can write that off, yep. Snacks, water, that kind of stuff, same thing, yep. Bring it back to your office, let everybody have some, okay? So don't pick on anybody. Retirement contributions, another thing y'all should be doing. That guy's 8 days from retiring. So 401k, a Roth 401k are great for self-employed people like yourselves. And what you do is, I think there's limits. I think it's $17,500 this year. Maybe that was last year. Anyway, you can, that lowers your taxable income for this year. It defers them. It kicks the can down the road. It doesn't really eliminate them because you'll pay taxes when you draw those in retirement. Unless it's a Roth, then you pay taxes before those. But yeah, with the standard 401k, this will lower your taxable income for a current year, and you'll get taxed on it when you pull it out, okay? Yeah, that can get real complicated real fast, so that's just high level, all right, retirement accounts. Health savings account, this is a really good one too, but there's limits to it, of course. There's limits to everything, jeez. So it avoids taxes before you have your W-2 or before you take business income. It lowers your taxable amount, and you can spend it on the other end on qualified things like braces for Darla. And you're not taxed when you disperse those either. So you can entirely avoid those taxes. But you have to have a high deductible plan, and the limit is something like almost $8,000 for an entire family. Individuals, $3,850. So it doesn't take a huge bite out of your taxes, but it's something. And if you do it right, you can save a few bucks. Okay. And these are things, there's a list of things you can do, like braces, hearing aids. It's not like, hey, go buy a bicycle and that counts towards it. It has to be something pretty specific, medical equipment, okay? Let's play Can I Deduct It? I got a crowd this big. Maybe I'll have you guys say, Can I Deduct It for the recording? No? Want to do it? Let's do it. Okay, on three, can I deduct it, okay? 1, 2, 3.
Can I deduct it?
And the music starts, right? Thanks. So, I got a few items here. Clothing. Haven't really talked about that one. Can you deduct your clothing? By the way, I love people who are brave and willing to be wrong. I love it. I'm one of those. Yeah.
You only wear it for work.
If you only wear it for work, maybe. Depends on what kind of work. It has to be hyper-specific and can only be used for that work. So my wife is a nurse. If she were self-employed, she can't write off her scrubs because they can be used for pajamas or whatever. Something specific like welding gloves or an auto mechanic's outfit that they're not going to wear in public, that's something that you could consider professional clothing. Even if it has your logo on it, that's technically not supposed to be deducted. So if you get audited and you have something, yeah, I wrote this off because I'm wearing all my clothing with my logo on it, technically not supposed to do that. Now, on the other hand, if you print a lot of t-shirts and give out, say you print 300 of them and you give out 299 of them and you keep one, like really a big deal, right? But if you just have a blazer or something special with a special patch on it, that doesn't really count as a tax deduction, unfortunately, officially.
Not even under marketing?
Not even under marketing, nope. Maybe the cost to sew that patch on could be. I know, that's a technical rule. People abuse this one all the time. And again, I'm not an auditor, so we don't ask for what that is necessarily. We'll counsel you on what's supposed to be written off and not. But if you put that in your expense in your marketing, we're probably not going to know. Now, if you get audited, yeah, that's on you, of course, right? Just telling you the official rules. Okay, what about a makeover?
No.
Actually, maybe. If you do a makeover because you're going to be on a TV commercial or on a show or something like that, that's business related. You can have a strong case there to be like, nope, that was a business expense. Or you're doing headshots. Or you're doing a podcast or social media. But generally speaking, if it's just to look nice for whatever, not supposed to. Okay? A manicure, we're all ready for one of those. Groceries for your family. So I legit talked to an agent a few years ago who was saying, yeah, I got groceries for my family and I wrote them all off because I talked to the cashier about real estate. It's like, no, that guy was shady. I won't tell you his name. Anyway, restaurant food. Yeah, sometimes. If there's a business purpose for it and you can back it up, sure. You can have a board meeting with the members of your LLC. It's not a date. You can have a board meeting with your spouse who is a partner in your business, take board meeting minutes, and have a nice meal at a restaurant. That's okay. What about a boat? Take clients out for a joyride. It's a client appreciation event.
If so, I want to know.
The problem is, this is a specific rule in the IRS that specifically smack down boats, except for if you are a fishing company or a scuba diving company, and that's all you, whale watching, whatever, right? And that's all you use it for. But a lot of rich people were getting away with writing those off. Their yachts, their $100 million yachts, oh, that's a business expense. IRS is like, no, it isn't. Yeah?
What if you rent a boat for an event?
That's a little bit of a gray area. I think the official rule is no, but if you serve food on that, you can write the food portion of that off. It's the official rule. Yeah, like I said, entertainment expenses are generally frowned upon unless it's a client appreciation event, like that's a marketing event. Okay.
Well, really, wouldn't that be similar to just renting a venue?
Not according to the IRS. Boats are specifically named in the code, unfortunately. I know. So, generally speaking, most CPAs and other tax professionals, their hierarchy of their blacklist is the IRS, and then Satan, and then mortgage underwriters. Anyway, what about a gym membership?
Yes.
Yeah, you can. If you set up a wellness program and every member of the LLC or employees have access to that wellness program, even if you're just a single member, yeah, sure. You know, you want to have one written out, and you can just find one online and steal that, it's fine. But yeah, you can write off things like that, wellness benefit. Okay, it's called a fringe benefit too. So employees actually if you have any employees in your business, and they will actually have a piece on their W-2, the value of that gym membership. Okay, that's called a fringe benefit. They're supposed to. Okay, charitable contributions. Can you donate money to lower your taxable income? Sure. Yeah, you can. Both as a person, individual, and as a business, you can do that. There's limits to that, like up to 50 or 60% of your taxable income, but most people won't reach that. Personal miles driven in a car or a boat with your logo on it. Is that marketing?
Yeah, I would say yes.
A lot of people want to say yes. It's not true. You can write up the cost of if you do a wrap or your logo or a magnet or a sticker on the side of the car, write that piece off. But if you're driving personal miles, you're going to a Super Bowl party, even if it's got your logo on it, you're not supposed to write those off as a business expense. So if you only have one car and you tell the IRS 100% of those miles are business miles, they might call you on it. So, sorry to burst your bubble on that one. Cell phone bill. Yeah, go for it. Hard to do business in 2023 without a cell phone, right? Other utilities. Gas, electric, internet. Yeah, you're supposed to have the portion of your office expense or your home office expense if you do that. You can write off that portion of it. So let's say your office is 10% of your house. Save your utility bills and write off 10% of them. Good. Concert tickets for prospective clients or employees. Well, I would say there's actually gifts you can do. If you don't go yourself, that's a stupid rule, but if you don't go yourself, you could do like a gift. And on the gifts rule for the IRS, not for the boards and local MLSs, right, is ridiculous. It's only $25 cap you can have. So if you spend $500 on a client gift, on a closing gift or something like that, you're only supposed to be able to write off $25 of those. Not my favorite rule, but it is the rule. Yeah, this, like I say, that's something I could probably consider that a gift if you don't go yourself, you know, which is advertising. So what about tax credits? There aren't actually a lot of tax credits available specifically for real estate agents. The personal credits come more into play there. You got the child tax credit, education credits from accredited university, and plug-in electric vehicle credit. So your Tesla in your driveway isn't just a status symbol, it's actually a pretty decent tax write-off. There's income limits on that too, but that's probably the most powerful credit available to most real estate agents if they do that. But again, is the juice worth the squeeze? Should I buy a $90,000 Tesla just to get a $7,500 credit? If you're gonna get one anyway, cool. Okay. Any questions on those, by the way? Okay. So, quarterly payments. You guys know you're supposed to pay your taxes quarterly if you're self-employed. A lot of people don't, and it's not that big of a penalty if you don't. It's only 0.5% of the amount unpaid each month. And if you're a first-year realtor or first-year self-employed, they don't have anything to go off of, so they let you wait until April to file that, so you don't have to do your quarterly payments. But if you've been an agent or if you've been self-employed for, over a year, your accountant will tell you on the first few pages of your tax return, they'll say, okay, you need to make quarterly payments, and here's the amounts each quarter. So if you do those, then you'll avoid this penalty. It's not much, especially if you're on the lower income side of stuff, but it could add up. It's money that you don't have to pay otherwise, so might as well do it. They're due April, June, September, and January on the 15th of each of those months for the current year. So January 15th is everything you made in Q4, right? And it's usually based on prior income. Like I said, if you're a first year as a self-employed person, then they don't have anything to go off of because they don't have a prior year. So you can wait until that time. I don't recommend that because you have a big tax bill in February, March, and April. But you can if you want to. So the rules are a little bit different if you make more than $150,000. They want a little more assurance that you're going to pay your taxes on time. They want a little more upfront. And they're easily paid online, irs.gov/payments. It's the most secure way to do it. Okay, and it's easy and it's not really a fraud risk for you. Okay. Any questions on those? Sometimes a question I get on this is, what if I have a crappy quarter, like I made nothing from January to March? Like, well, you can everything is shored up at the end of the year on your return. And so if you can show that you didn't have any income for that time, you won't owe any taxes. So it can kind of go up and down as you have better times of the year than others. So, but I mean, the cleanest way to do that is just to do the quarterly if you can. Okay, but if you don't have the money to pay it, I get it. You can kind of play that as you make more.
Do we have to pay like 75% of the previous years?
It's 90% of the previous years typically. It could be 100% if you make 150,000 or more, but it's typically 90% of what you made the previous year as a self-employed person. Okay? Or as a business, any size business is true. So how much should you save? How much each paycheck do you save for taxes? Anyone? This is what I'm going to have here is a suggestion because it's different for everybody. What have you guys heard? What have you guys done? 30?
30.
Yeah. 40? Yeah, that's safer, certainly. So general, I like 30. If you're on the lower income side, you can get away with a little less than that. The thing is, if you save too much, is that a bad thing? Yeah. Awesome. You have a little more than you save. You have some birthday money or Christmas money or whatever. So 30% is the general rule. A little higher if you make more. But that will cover your income taxes and your self-employed taxes for just about everybody, and probably a little extra just to have a little buffer. Okay? So what do you keep track of? Right? That's small. Client invoices, of course, that's going to matter more if you're the principal broker or the title rep or something. But business expense receipts. Well, what if I just have a business bank account? Doesn't that have everything on it? the IRS can use business bank account line items, but sometimes those are pretty vague. So if you go to Costco and you can buy everything at Costco. You could buy a table or you could buy a bag of oranges, right? And we don't know how much of that is personal or if it is personal. So things like that, that's why you want to save receipts. And generally, just carry a pen with you too and write down what it's for. If you don't know if it's a business expense, by the way, or a personal expense, put it on your business expense account. And then reconcile it after you ask us, hey, I spent this, here's what it's for, can I write this off? We'll tell you yeah or no. Then, okay, well then take it out of your business and make sure you have a note there, okay? To keep your business account clean, okay? So it's great to have a business bank account and use that card for everything you can that's a business expense and questionable things that you don't know. It's a great idea, okay? And your receipts are the best protection against an audit. Mileage, like I said, those apps are fantastic. And at the end of the year, just hit, hey, upload or download my results. It'll give you numbers, send that to your CPA, off you go, pretty easy. You could do it by hand in a notebook if you want to, but that's pretty tedious. Auto expenses, if you're going to do the expense route instead, which generally I don't recommend, especially if you're trying to qualify for a mortgage, but not a bad way to go, especially if you don't know yet. This is your first year in business. Keep track of them both if you want. See which gives you a bigger bite. Home office square footage. This could be in your title docs, your closing docs, or it could also be just measure it out, right? Grab a tape measure. Cell phone bill, keep those obviously, utilities, internet, that kind of stuff too. Meals, don't take the 50% deduction yourself. Just hand us, just tell us what that total expense is and we'll do the math for you. So give us all of the receipts or give us the full number of everything you spent on meals, okay? And it's good to write notes on the back receipts. Like I said, I met with Bob, talked about investing, good enough, okay? Quarterly payments, you want to keep track of those. You can do that on the IRS website too, okay? Anything else you guys have heard to track of that I kind of missed here?
Business credit card.
Business credit card, yeah, that's kind of in your business bank account there.
That was separate.
Bank account and credit account. I mean, if you're doing points, yeah, cool. Use them both if you want to. But keep track of those both. I do have on the back, I think the very last page of your handout, a list of a whole bunch of expenses that real estate agents could typically run into that you can write off as business expenses. So you feel free to refer to that as you want to. A lot of them you probably already know, like, yeah, I know I can write off my flyers for my open house. I know that. But just a little handy chart for you if you want, okay? And some of those things you want to keep your receipts for, right? Or pretty much all of them if you can. Okay? So any questions on those, by the way? Or what to keep track of? All right.
So if you take a closing gift and you somehow put your marketing sticker on it, does it now become a marketing material?
No, that's considered a gift. And if it's audited and they catch that, they'll come down on you. Yeah, marketing is probably the loosest one that, throw a sticker on whatever you want and we can call it marketing. That'd be nice, but that's not the way the IRS sees it, unfortunately. So, good question though. So, how income tax brackets work. I put this in there because I kept getting confusion on this. So, their income taxes are progressive and based on marginal rates. That's not a political term, that's just how they work. That means the more money you make, the more you are taxed on those higher levels. So they're based on marginal rates. So let's say for a married filing joint person making $100,000 of wages, they're in the 22% tax bracket, right? So they're going to be taxed on 22% times $100,000. Does that mean they're going to owe $22,000 in taxes? No. So this is true for everybody. Everybody who makes an income, the first $22,000 is only taxed at 10%. Okay, the next, 60,000, 67,000 is taxed at 12%. Okay, and it just goes up from there. So their total bill here isn't 22,000, it's actually 12,615. A lot of people I've heard before have said, hey, I don't want to get a raise because I'll have higher taxes. Like, no, that doesn't make sense, right? Go after that raise, go get it. Same is true with commission checks. I've never heard a realtor say that, thank goodness, because most of them understand that, but just wanted to throw that out there, okay? Okay, now we're going to talk about owning real estate and tax benefits of that. First of all, we have Section 121 exemption. What does that mean? That's the 2 out of 5 year rule. So for primary residences, not investment properties, if you occupy that person for, if you occupy that residence for 24 of the last 60 months, why did I say it that way instead of 2 out of 5 years? Because we've had clients who have moved out for 3 months and moved back in for another 4, whatever it is, kind of just bouncing around a little bit. So it really is 24 of the last 60 months. If they occupy that home and then they sell it within that 60 months there, they get an exemption on capital gains tax. So how capital gains taxes work, say you own an asset like a house, you buy it for $100,000, you sell it 5 years later for $500,000, that's $400,000 of gain, right? IRS knows, they don't know, but the IRS wants taxes on anything you gain, whether it's income or selling assets like that. However, if you live in the property, you have an exemption here, $250,000 or $500,000 exemption if you're married filing jointly. So in that example, a married couple who has that $400,000 gain, that's fully exempt. Whoops. Here we go. That's fully exempt. If he was single, since $400,000 minus $250 exempt, they will owe capital gains on $150,000 of that gain if they're single. Okay? Does that make sense? So you can live in it for 2 years, rent it out for nearly 3, and sell it and have a big exemption there. Okay? It's a good way to do it. Question on that?
If you do improvements on the home, you'd also be able to deduct that, right? New roof, septic tank, something like that.
It's a great question. It was, if you do improvements on the home, can that be factored into this so far? Yes, it can. So let's say you do $100,000 worth of improvements and you spend that and you have the receipts to back that up and the invoices, then that lowers the amount of capital gains you have. So if you, in that example, he would have the $400,000, right? If he bought it for 1 and sold it for 5, he'd have $400,000. But if he added $100,000 in improvements, he spent that. So it's only $300,000 that would be recognized as a capital gain. Okay.
Do typical expenses apply if you're realizing a larger than $250,000 gain? Can you write off then mortgage interest and insurances against your capital gain?
That's income tax stuff, which is a little bit separate. That's going to kind of, so your ordinary income and your capital gains are going to determine the mix of how much you owe of each. It's a little bit more complicated question.
Okay,
Yeah, but that's a good question though. 1098s are a thing, and I'll show you how to do something cool with those with a reverse mortgage in a point. But yeah, mortgage interest is deductible, assuming you can itemize. The threshold for doing that for married couple filing jointly is like $23,000. With interest rates where they are, that's entirely possible. So anything above that $23,000 that they pay in mortgage interest, they're going to want to itemize because they'll get better tax benefits from that. So yeah, question.
When you own a rental property and you do sell it, you're obviously subject to capital gains tax. What's the bracket? What's the percentage that you usually pay?
It depends. It's 0, 10, 15, or 20, depending on other things.
20
So.
would be the max.
Yep, for now. Some people trying to change that into ordinary income. I don't know what'll happen there. Proration is possible, by the way, so if you live in it for 18 out of 24 months, there has to be a justifiable reason to the IRS, like, hey, I got really sick, or I changed my jobs, or I got married, or divorced, or something like that. We can often find a way to get that done, but you do have to explain why you did that. And it's prorated too, so 18, you'd have 6 out of 12, 3 out of 4. You could take 3/4 of this exemption if you had a big one. So, yeah.
Also, I learned this personally. So if a spouse dies, if they sell it within 2 years, they can still take that $500,000 instead of the $250,000.
Yeah, that's a little bit in the weeds, but yeah, there's special rules for this, but this is a general rule here. Thank you, that's good. Yeah, like I said, weird events happening like deaths are particularly sensitive. They have special rules to help people out who are grieving, right?
I thought there was a bill before Congress to raise that to 500 for single and $1 million for married.
Again, I'm not going to talk about what's proposed. I'm going to talk about what's actual law right now, because there's no way to know if stuff is going to pass or not. So, anyway, okay. So like I said, investing in real estate is awesome, and the tax benefits can be your top reason to do it. One of the things here, depreciation, the government expects your home to look like this at some point, and that's a real cost, right? On paper, at least. So it lowers your taxable income, but not your bank account, right? It's pretty cool. You can depreciate the building, but not the land. So if you have a $500,000 property, usually we'll do a quick calculation, maybe depending on what kind of property it is, like a single family home, we might exclude 20% because you cannot depreciate land. We depreciate the rest of it over 27 and a half or 39 years is the standard if you don't do anything special like accelerate that depreciation. By the way, this is awesome on a mortgage application because depreciation doesn't account against your debt to income ratio. So if you have someone who is a big time real estate investor and their depreciation effectively made their income look like zero or less, but they actually have like $200,000 in other income, like we're going to qualify them on $200,000 because that does not dig into your debt to income because it's not considered a cash expense. So real estate investors, if they do it right and they prepare their tax returns in a way to do that, assuming it's accurate, have a really big leg up on qualifying for mortgages. It's a great thing you can do, okay? Even if that is accelerated, like that $100,000 SUV that you buy, that would be considered depreciation. So that would not count against your mortgage qualifying income. It would lower your taxes, but not your mortgage qualifying income. Good stuff, yeah.
What about this 39-year straight line depreciation?
So let's say you have a property worth $100,000 for easy math. You would take 27 and a half years if it's a residential property, a long-term rental, and depreciate that $100,000 you could expense every year for 27 and a half years until it gets to zero.
39 years for commercial property?
39 years for commercial and short-term rental properties, which is considered commercial. Yep. Even if it's a residential property, if it's short-term rental, that's considered business income, 39 years. Or you can accelerate it, which I'll talk about next. So, cost segregation is one way to accelerate that depreciation greatly. So, on the non-building components, so if it's not a wall or a foundation or a roof or something that's actually, part of the building itself, like fences, some above ground plumbing, some wiring, flooring is a popular one, security system, that kind of stuff. We can actually segregate that, that's why they call it a cost segregation, and depreciate that in 1 year right now. So we can greatly accelerate like 20% of that property in 1 year, which could really, I'll show you the effect of that in a second, but it doesn't really make sense to do it unless you have enough active income to offset it. So you do a cost seg study and you lower your taxable income by $100,000 and you only made $50,000 that year, it doesn't make a lot of sense. Okay? Yeah, activity. So don't look at all these numbers here. Look at this one. This is $115,000. So this is a cost seg study one of my partners did on a $450,000 property, I think. And since we took all the components on there, like finishes, furnishing, plumbing, gas, HVAC, electrical equipment, all that kind of stuff, and we depreciated that, accelerated it, it lowered this person's taxable income by $115,000 in 1 year. So if you have a mediocre investment property and it's not, cash flowing the way you want it to, there's a lot of other reasons to have real estate, but for the tax benefit alone, we're saving this guy probably $30,000, $35,000 in taxes. He's pretty happy. So one caution about cost seg studies too is you don't want to do that if you are selling it within the next 5 years-ish, because that is recaptured. You can avoid that with a 1031 exchange. Takes a little bit of maneuverability, but it's another tool in your arsenal. Okay, so you could take a 2-hour class on 1031 exchanges, and I hope you do. I don't teach it yet, I don't have one, but there's a lot of great ones out there. But anyway, it defers. Remember the capital gains I talked about when you sell a property? If you buy a property $100,000 and you sell it for $500,000, you have $400,000, which will be taxed at capital gains rates. You can defer some or all of that by doing a 1031 exchange, meaning you sell this property and within your certain amount of time frame, 45 days, you go under contract for a new property or properties worth at least what you sold your old one for, and then you can kick that can down the road. You don't have those capital gains taxes. You can kick that can all the way down the road until you kick the bucket, which means a step up in basis. Your heirs do not pay any taxes on the capital gains. So 1031 exchange defers some or all of those capital gains. So a great way the government is used to encourage investment in real estate. Okay. I know this is, a lot of rules here. This could be a 2-hour course, right? So take a class on that if you want more details. But if you defer those capital gains taxes all the way until your death and your spouse's death, if you're married, your heirs don't owe any capital gains tax on that. It's awesome. So great inheritance strategy. Okay. So for example, that's Phil Dunphy, right? Real great real estate agent, iconic. Let's say he bought this property in 2015 for $300. It's worth $450 today. It's an investment property. He just rents it out. He doesn't live in it. If he sells it, he'll have a capital gain of $150,000. But which could trigger up to $30,000 in taxes if he's taxed at 20%. Now, if he does a 1031 exchange, he goes under contract within 45 days for a larger property, a more expensive property at least, and he closes within 180 days. Those are the basic rules of those. And he defers that $30,000 in taxes. Smart move. By the way, you want to get familiar with these with your investors because number one, it's good for your business, right? They have 45 days to find another one. So they're gonna roll those transactions. If you help them, you're knowledgeable about these, you can make some good money. Yeah.
So if somebody as a private resident, wants to buy another property, but then let's say, how long do they and then they rent it out, and which would make it an investment property, correct?
So if they can.
How long do they have to wait? Is there any wait time before they can sell it as an investment?
So let me see if your question is how I understand it. The question is, if you have a personal residence and you convert it into an investment property and buy another one for yourself, how long do you have to wait for it to be a business property before you can engage in a 1031 exchange? It depends on the accountant. Some of them are as aggressive as 1 year. A lot of them are 2 years. A lot of them are just one tax return. So if you buy it in December, that's really risky. That's pretty aggressive. But generally, I would say between 1 and 2 years that it has to be a business property, either a rental or used for some other kind of business, whether you make t-shirts out of it or whatever, and that's all you use it for. That'd be a business property. Usually 1 to 2 years is what they want to see. Okay, good question.
Does capital gains tax take into consideration how much you owe on the mortgage when you sold it?
Yeah, and the 1031 exchanges have to do with that too. Just talk to your accountant later when that, I'm not going to do the math here, it gets too weedy, but okay. Good question though. Yeah, it does take into account the debt you have in it. And if you make a gain on your debt, that will cost you in taxes a little bit, but it might be better overall, so. Okay, short-term rental loophole. This is one of the few loopholes, true loopholes kind of left in the tax code for, depreciation, accelerated depreciation is kind of a loophole in itself, but this one is kind of, one of the few things you can do for somebody who is a W-2 earner, like that engineer I talked to you about, who is making $150,000, to lower his W-2 taxable income. So allows a non-real estate professional, a non-reps, right, to lower their taxable income by using a cost segregation study, right? There's some moving parts in here, but if you do it right with the right accountant, they know how to navigate this, you can save a lot of money legally. So it's got to be a short-term rental property, and it can decrease W-2 income taxes. The quick and dirty rules here, the average stay of that place has to be 7 days or fewer. So it's got to be a short-term rental. The owner of that property must actively participate in its administration, property management, for at least 100 hours and more than anybody else works on that property. So a common tactic when you're doing something like this, a short-term rental loophole, is to buy a property in like October, spend November and December fixing it up, painting, doing new carpet, finding renters, that kind of stuff, starting it up, having a few tenants by the end of that, by 7 days or fewer, and then do a cost segregation study, knock your income, your active income down by 100 grand or so. That can save a lot of people, it can save some wealthy people a lot of money in taxes. It's funny how the more you understand taxes, it is often written for wealthy people, but still good to know for your investor clients so they have a good understanding and can take advantage of these, right? that'll win their hearts for you. Augusta rule, I told you I was going to talk about this. So the Augusta rule is essentially you can rent out your primary residence or even a rental property. Well, primary residence really is how this works the cleanest. For up to 14 days at market rent and not be taxed on that income. So if you rent out your place, your primary residence for, I don't know, $500 a day, you can't make it ridiculous like, yeah, $20,000 a day, I swear, when it's a house out in West Valley or something, because that's not market rent. You'll be called on that. But if you make it reasonable, rent it out for up to 14 days, you don't even have to report it on your income taxes. Pretty cool. The rent's got to be reasonable. You can't do that in the home office deduction. So if your house is conducive to holding board meetings for your business, might be better to do this. Ask your CPA. And you want good documentation too. So if you get audited and you have this in there, you want to have, here's a contract, my business did this. You want to have receipts. You want to see payments, actual payments going in and out from your business account. So, and take board meeting minutes.
Are you talking about like Airbnb kind of?
Mostly for a primary residence is where this really works. You could do an Airbnb too, yeah.
Okay, would that apply?
Sorry?
Would that rule apply, the Augusta rule?
Yeah, up to 14 days, yeah, you could do that. If it's like on Airbnb and you only rent it out for 13 days on Airbnb, like you can't really justify that.
Is that per year?
Per year, 14 days per year, yeah. Okay, any questions on that? Like I said, document it. You can take that too. RJ.
The real advantage of that is when you have like a corporation and you kind of rent the house to yourself so that you have an expense for that business, but yet a non-revenue event.
Yep, you rent it out, so me, Dan Mullen, rents it out to Dan Mullen Capital, LLC. I can do that, right? As long as I have money changing hands, I have it well documented, I can make that money as a person and not report it to the IRS and not be taxed on it. It's legal. Okay, good question. Qualifying for a mortgage while you're self-employed. Anybody have trouble with this? It's kind of sticky, huh? Be a magic trick. So employees are underwritten, regular employees who engineering jobs, whatever, using their pay stubs and their W-2s, right? Self-employed people, on the other hand, are underwritten using their tax returns. So if you have a CPA who made you look poor to the IRS and a mortgage company, maybe you made $150,000, but according to the IRS, we took these cool deductions and you only make $50,000, it might be difficult to qualify for a mortgage with $50,000, right? So, but good news is mortgage qualifying income isn't necessarily taxable income. So you should talk to a tax professional who understands that concept and is willing to work with your loan officer, or maybe one who does both. So, yeah, so having that knowledge and understanding, hey, I want to go aggressive on my taxes, but how will that affect mortgage qualifying income? You should tell your CPA, hey, by the way, in the next year or two, I want to try to qualify for a mortgage. And they'll be like, what does that mean? Well, talk to my loan officer. He can help you understand that a little bit if they're any good at that, if they specialize in self-employment. Okay. So that's a good idea to nip that in the bud early when you're talking to them when you're doing tax planning at the end of the year, like right now, or at the beginning of the year, early January. Bring that up, okay? Any questions on that? So, taxes and reverse mortgages. I freaking love reverse mortgages. They're so misunderstood. They came out of the gate pretty ugly in 1989 when the FHA introduced them because people were being taken advantage of. There were annuity salesmen that were like, yeah, do this reverse mortgage and take it and invest with me. Kind of predatory kind of stuff. They fixed a lot of that in 2015 and 2017. They closed they added a lot more protections to senior citizens to make them a lot more viable and a lot less vulnerable to, maldoers, of course. Here's one of the things you can do with these, by the way. A lot of great reasons for reverse mortgages. It's not just for the destitute, by the way. In fact, they're best in concert with your entire financial plan, with your qualified IRA, with your 401k, with your life insurance, with your annuities. If you're using all of those, this is an excellent tool to pull money out of your qualified IRA tax-free. If you do that with a reverse mortgage. My parents just moved in September up in Syracuse where they live now, or West Point more specifically. But because we're utilizing a reverse mortgage, number one, they don't have a required monthly mortgage payment. Still got to pay taxes and insurance, of course. But because we're doing what I'm going to show you, they're probably going to save between $100,000 and $150,000 in taxes over the course of their life by strategically using a reverse mortgage. Well, how does that work? So say you got a traditional IRA and you want to pull $100,000 out of that IRA. What happens when you do that? Yeah, tax, right? So you want to put that into your bank account. When you do that, let's say you're taxed at a 24% marginal rate there. You're going to get a 1099, which will hit you for about $24,000 in taxes, right? Ouch. Making your $100,000 $76,000. Oof. What if instead you had a reverse mortgage for a few years and you had accrued interest to the tune of, I don't know, $100,000 magically or more? If you did that and you put this money into, you paid off that interest in your reverse mortgage instead, you will get, well, you have your 1099-R there for $24,000, but you will also get a 1098. When you pay mortgage interest, you get a 1098, right? With a reverse mortgage, you can choose when to pay that. So it could be several years before you do that. So you can essentially stack this 1098 to be $100,000. What that does, well, that cancels out the tax bill for pulling money out of your IRA. But wait a minute, I paid interest on it. If you do it right and plan it well, just wait for 5 or 7 days or whatever for this to process, pull it out of your reverse mortgage, you just got that $100,000 tax free. Reverse mortgages are so much better than everybody thinks. There's one reason why. Okay? That again. It again. You can pull money out of your traditional IRA essentially tax-free by using a reverse mortgage. You have to plan for this, right? This is a few years, of accrued interest. But if you do that right, you can save a lot of money. You can do this over and over and over as long as the person is alive and as long as this makes sense and there's money in there. Okay? Great reason to do that.
Retirement age, like 65?
Well, for most reverse mortgages, you have to be 62 in order to get one of those. And you have to have enough equity in the home. Talk to your loan officer about that. If you don't have one, I know some.
So you're telling us that they can take money from their traditional and put it onto their home or onto their reverse mortgage and then take their money from their reverse mortgage into their living area?
That's exactly what I'm saying.
Does that work for 401k as well?
Yeah. Mm-hmm. It's anything that's going to generate a 1099. So real estate commissions even.
So you might as well be doing a traditional IRA and not worry about the Roth.
Assuming this is still allowed, which who knows? I don't know if enough people do it, if they'll be like, hey, hang on, these people are doing that. But for now, this works beautifully. And assuming it will. There's limits to it, like up to $750,000. Your mortgage has to be $750,000. But they prorate that if it ends up being like $1 million, which is around the current limit of reverse mortgages. So you can take $750,000 year after year after year and write off that amount of interest, generate that 1098 for you. Be a powerful tool for someone who's got traditional IRA and doesn't want to make mortgage payments. Okay? So yeah, there's a lot behind there. I love reverse mortgages all day. They're some of my favorite. I think it's going to hit this nation like a tidal wave once people understand what they really are and what they can do. So, okay, so how do we give tax advice as a realtor? Right? Anybody remember where this is from? Delta, yeah, Delta Airlines. Is an old lady who is, she's not old lady, but yeah, smoking is not allowed, right? In short, don't. You can say, well, as far as I know, I think this is a rule, but you really should ask a professional, a tax pro. Okay? That'll keep you safe from liability and all that kind of stuff. Keep your license clean, right? Questions? That's it for now. I know that's a lot. I hope the notes were helpful and the materials were good for you. But do you have any other questions here while you're here? Usually we charge hourly for this, so.
Do you own investment properties?
I do. It is. Sorry? Do I want to buy another one? Eventually, yeah. I'm a little leveraged out right now, but got to qualify for a DSCR right now. Anyway, any other questions? I have a course on investing. You might like it. I have to convince the lady out there that I should teach it again. I like it. I love investors. So, awesome. good stuff. Okay. Well, you have earned your credit. I appreciate you coming. I have more after this about me since we don't really have a, oh, do we have a sponsor? Oh, okay. But thank you for coming. You've earned your credit. You don't have to stay if you don't want to hear my pitch, but I have a lot of cool things that can help you guys out as realtors if you want to. So I think that QR code is also on your handout, but yeah, I generate content. I do it weekly for real estate agents, for clients on useful stuff. I hate spam, and I don't want to give it any more than I want to receive it. So if that's, I do ask you if you want to receive that in that link here, but if you don't want to, I don't want to send it to you. But I usually do things to help clients understand the financial impact of their real estate decisions. That's really important to me. That's kind of my approach to how I run my business. I do taxes, I do mortgages. I like that. I have other CE courses. These are currently approved. I'm always making more. This is my favorite part of my job, is doing these. You guys just took this one, Real Estate Tax Hacks. I have Winning and Creating Investor Clients and the True Cost of Renting, which I hope you stay for. That's one's coming up next. That dives into the financial reason of why you want to own your first home. And because people buy homes based on, non-financial things, right? They want to stop sharing a wall. They want a yard. They want to own a pet more easily, whatever it is. But then they turn around and say no for financial reasons. I kind of break down the financial reasons of why you absolutely should own a home if you can in that class. And that's next. I'm making a couple more next time home buyers for people who wonder if why they should give up their 3% interest rate. My reverse mortgage is actually coming up next, not your grandma's reverse mortgage. I have a very different play on that one. Most of them I've seen try to teach you how to be a reverse mortgage loan officer. And you guys don't need that. You guys need to know what they can do so you can recognize opportunities and help your clients better. That's how I designed that reverse mortgage class. And then I'm going to do a self-employed one too, because that's kind of my niche since I speak tax and mortgage. So also I love content. 2024, I'm going to have a huge focus on making content. As realtors, as anyone in self-employed, that's how people look us up these days. They might Google us, yeah, but they'll also say, okay, who is that person? Let me look them up on social media. Oh, they're not really, they don't know what they're doing. If you want to up your social media game, we can make an appointment with me, come to my office. I'm building a studio. This is already built, but I'm upgrading it significantly, spending some money on it to make it really nice for recording. So if you want to make some content, we really could just do like a 60-minute conversation, or I can provide you the topics if you want, or bring your own. And we can send them off to an editor. You can have 3 or 4 months of reels in one pop. It's a pretty good way to go. So I can help you do that. That's a lot of fun. And I do mortgages quite a bit, and my specialty is self-employed clients, which is typically the hardest kind of mortgage to do, because tax returns, speaking IRS, not a lot of loan officers fully understand that very well. But speaking both IRS and mortgage is awesome. And so that also means that the loans that aren't self-employed, those are easier too, because this is just another level. So I also do taxes too, of course, on the side, and that can help somebody who's wanting to get a mortgage. I understand what the mortgage qualifier, what the mortgage underwriters are looking for, so I can, within legal bounds, I can prepare their tax returns knowing that. So if you have self-employed clients who are struggling with that, I can help them out. Oh, and I happen to work for a broker. It's called Summit Home Loans. Sometimes brokers have a reputation of not closing very fast, but we get them done 2 or 3 weeks, and we have almost always better rates and fees than our retail lenders out there. So I do a great job. RJ's on my team. He's a great guy. And one last thing, my brother, who's a financial advisor, and I, who's a CPA, are starting a group. It's called Lifetime Real Estate Advisors, which it's a free group. It's on Facebook right now. You can search for it. It's kind of fun. And the object of that is to help you as real estate professionals earn your seat at the table, the same table as your CPA or your financial advisor, because in all honesty, the impact you have on your clients, the financial impact you have on your clients, is significantly greater than that of your financial planner even. These several $100,000 houses, their investment portfolio grows and grows, but that financial asset, their house or houses, if they're investing, is huge. So we have a group that's trying to help real estate agents and eventually loan officers up their game to be able to sit at that table. So if you want more information on that, just look us up on Facebook, Lifetime Real Estate Advisors. It's free. We don't charge anything for that, obviously. But we'll have a every Friday we're going to do like a 20 or 30-minute podcast on particular topics that fit within this theme. Okay, so go ahead and join that if you want to. It's a lot of fun. I only really offer this right now to people who have taken one of my CE courses. So that's what we have right now. Okay? That's me. Thanks for coming.
Thank you.